Matthew joins us now. Let's connect with him to understand the market mood, the current commentary from Fed, and how will this impact emerging markets like India. Mark, so good to have you back. Thank you for joining us. Is this a new look, Mark? I haven't seen you wear these fancy glasses.
Well, these glasses are not new, but thank you for noticing them. I am in a new studio in our office, though.
Okay, so the backdrop which is new. I was just wondering what is new about Mark today. But the new thing for financial market is that Fed has changed their outlook. They are talking about a solid recovery for the US economy. And that, unfortunately, is not translated into great news for emerging markets. So do you think the reversal could happen now in terms of US bond yields going higher and money moving back to emerging markets, to US equities or US bonds?
Well, you're right to identify the Fed's more hawkish stance as the reason why equities globally have been soft. It was the 27th of July when the Federal Reserve removed its talk about a recession from its statement at the meeting in July, and that was the peak of the S&P. It's down about 5% since then, and other markets are as well. So it's ironic that not having a recession, the market interprets that bearishly. Why? Well, of course, because it means yields will be higher for longer. And I do think that the Treasury yield at around this level is offering very serious competition to stocks. Not just the Treasury yield, but investment-grade corporate bonds in the US are now giving you over 6% yield. That's a really high yield for an asset class which has never defaulted more than 1% default rate in the worst year ever, the global financial crisis. So I know that sounds bearish, everything I said, but actually I would still stay in stocks. I think that one of the good things about taking the recession out of the forecast is that we do have strong growth, and the third quarter results that will come out middle of October should show the S&P with a positive year-on-year earnings growth for the first time in 3 quarters. And if you exclude the energy sector, it'll probably be up about 3.5% to 5%. And next year, once again, assuming no recession, earnings growth is looking like it'll be above 10%. And by the way, for 2025, the analysts are also looking for around 11% earnings growth. So I find it difficult to see stocks going down in a backdrop like that. It's just that you also now have a very attractive alternative in the bond market that you didn't have for the last 10 years.
Mark, we were just speaking with Cameron Brand of EPFR, who tracks the fund flow situation very closely. And he was telling us that because of what's happening in the US macro scenario, there are some pressures. In fact, outflows are happening from Asia funds, and they may take a bite out of India as well. But India dedicated funds are actually seeing or witnessing record inflows. You track India closely. Do you see this outperformance on flows continue for India despite what's happening in global macro?
They're hard to predict, and I think one major headwind for India and the entire emerging asset class has been historically a strong dollar, and of course we've got the dollar index at about 105 now, which is a problem because there is less appetite for emerging markets when their currencies go down. But the good news is, as you know, that JP Morgan is including Indian bonds, Indian onshore sovereign bonds in its global benchmark index, and that will be attracting tens of billions of dollars of inflows into rupee-denominated assets, bonds, over the next couple of years. And I suspect that Morgan Stanley will also move Korea from emerging to developed in its equity benchmark next year, which would also necessitate, I think, several $billion finding new homes in the emerging equity space, and I believe India would be at the top of that list too. So the fund flows, I believe, will remain positive into India. The only caveat is if the geopolitical situation, which unfortunately, India is now in the headlines about, continues to deteriorate. And then at the margin, you might see less foreign buying. But I still think that the local buying is ultimately what's going to drive the market in India. So it's nice to have the foreign inflows, but I don't think they're a necessity.
Because foreign flows, at least in the last month, haven't been that supportive. It's only the domestic flows that have actually supported, Mark, because in the last month there was an outflow to the tune of around 25,000 odd crores. But if I can just drill it down further, within the Indian markets, which are the pockets do you think are likely to do better? Is it going to be those domestic-facing names, the consumption story, or do you find a case to be made for the export-facing names, the defensives of the world like IT and pharma, because they had been beaten down?
I think it's a wonderful buffet, and basically everything on the menu is good. There's almost nothing in the market sector-wise that I don't like. Everything you named is good, and broadly speaking, if we get nominal GDP growth of around 6 to 7%, you add on inflation, real GDP growth in the low teens, we're going to also have earnings growth of around the same magnitude, and therefore should expect around 10% return in the stock market each year. And so within the stock market, what will outperform, I think it will really depend on the year and on the month even, but broadly I'd just be invested in the Indian stock market on that macroeconomic basis that GDP growth will be in the 6 to 7% range for the next few years. And that does take you to the consumer, that does take you to the banks, and then IT is growing very nicely with, India, there was a study done by Stanford University, and they found India is the country that will benefit the most from generative AI in terms of the talent pool that is accessible in India to work on it. Defense, you mentioned also, so I think it pretty much all looks good.
Are you happy with the 10 to 11% kind of return? Because usually, people come to Indian market to expect higher growth. And even, yes, growth is there, the earnings growth is going to be supportive, but everything is good at a price, right? The mid caps and small caps have had a runaway rally. Are you not worried about it getting frothy or the valuations being a bit expensive?
For the mid caps, yes, for sure, that is the case. And I think there's still going to be very good returns in the mid caps, but one has to be selective given the big run up that you talked about. And for the broader market, I'd be perfectly fine with a above 10% return, especially because I do believe that notwithstanding the high oil price, India's current account balance is shifting to a structural surplus driven by import substitution. That is now possible given all the investments in physical infrastructure that have been made. And therefore, I don't think we're going to see the kind of strong, weakness in the, that doesn't make sense, but the big weakness in the rupee that we've seen over the last 10 years.
The other global theme which India seemed to be benefiting out of is the capex theme, especially towards energy transition and renewables. We are witnessing Indian capital good companies, the big ones, the mid-tier ones, or even transmission tower companies starting to talk about a large export opportunity, be it wire and cable companies, all of that. Do you see this global capex theme and how manufacturing can be outsourced to India, a lot of high quality capital good manufacturing? Are you interested in this theme? Would it interest you?
Yes, I am. I think it makes sense. And as I said, that the physical infrastructure that you need to make things is now being put in place that didn't exist, say, 10 years ago. And we've seen tremendous amount of investment in productive assets just over the last couple of years. And many foreign companies have expressed an interest in making things in India. And the ones that have already gone ahead have been successful largely in doing that. So I do think that's one good place to be, yes.
Sure, point taken, Matthew. But tell me, what's the biggest overweight for you? What is the sector or stocks that you have been incrementally buying into?
Financials would be our largest overweight, just on the premise that NPAs have been come down to, you know, single-digit levels, and the capacity utilization and the corporate sector is 80% plus, and so there's a strong demand for loans. We like financials generally, banks in particular. That I think is our largest overweight.
Okay, Mark, really appreciate you joining us on the show. So financials remain the top overweight, liking India at the moment despite the kind of macro uncertainty that we are seeing on a global basis, and expecting 10-11% kind of returns from India, which as per him are quite healthy.